for Quebec, and if you need help with Quebec, I can help you. Any other provinces, Mike and Lee-Anne they're your team, and they're real estate investors themselves, so they know what you need to refinance and get the most out of your investments. So tonight, Sarry Ibrahim, I'm not sure I said it right, but a great guest from Chicago. So we're really excited to learn about Bank on Yourself, I think it's called. And it's a great concept. Jennifer and I have been trying to grasp it. So This is excellent.
And I love the fact that you're kind of focused with real estate investors. So why don't you introduce yourself for those who don't know who is Sarry and what does he do?
Yeah, Francois and Jennifer, thank you so much for having me on your show. I appreciate it. I'm looking forward to having an awesome conversation. Yeah, so a little bit about me. I'm from Chicago, Illinois. I was born and raised here, lived here my whole life. I live in the city in Lincoln Park, for those of you familiar with Chicago. And I, like you guys mentioned, I run a company called Financial Asset Protection. It's a financial services firm. And our main focus is infinite banking for real estate investors. So that's who we niche down to. And I look forward to talking about infinite banking with real estate investing.
Oh, that's so cool. So why don't you, just for people who don't know, kind of break it down kind of in layman's terms, what is infinite banking?
Because we know lots about limited banking. So you go to the bank and they say no, we know lots about that. So infinite sounds amazing.
Yes. So I guess in order to really understand infinite banking, I guess it's good to start with the objective, like why would somebody want to do this? And typically right now there's about 450 different financial vehicles you could use. So if we are, for example, let's say real estate investors, and we're looking for ways to grow wealth, especially tax favored wealth, and to always have access to this wealth, to never be turned down for a loan, there's only 1 out of 450 vehicles, and I'm speaking generally North America. So 1 out of those is dividend-paying whole life insurance, and people are always like, how could whole life insurance help with real estate investing? I thought it was just life insurance. What does it have to do with investing in real estate? And that's a valid concern. But for a lot of people who don't know, whole life insurance actually has 2 functions or 2 aspects to it. One is cash value, and the other is life insurance. So with infinite banking, obviously we're talking about more on the cash value side and building that up over time, and then being able to use that for real estate, for other types of businesses, or even for personal reasons. There are no restrictions on what you could use the money for. So that's kind of what it is. It's using dividend-paying whole life insurance, mostly on the cash value part, while we're still living, for anything that we want.
Yeah, I like that part, that while we're still living, because usually you buy life insurance and it's for the kids or whatever, next generation, or your wife. Like sometimes I'm worth more dead than alive. So Jennifer, I get scared. Is she gonna cut my brake lines or something?
I still keep him.
So or the opposite. But while you're living, why not spend it? Spend it wisely, of course. Don't just get Botox or something, but get investments. And that's what we love. So we love this. And just before we came live here, you were telling us about your goals and objectives. I don't know if you mind sharing, but you seem fairly young, and I love what you're already looking at. What's your vision? So.
Yeah, definitely. So we were talking about real estate, and I see myself more on the passive side of investing in real estate deals passively. For those of you, obviously, I'm sure your audience knows what that means. I'm just investing in deals. I'm not going out looking for them. I just see more of my strength on infinite banking and helping clients with that, and then investing my profits into deals as a limited partner. And I plan on actually using my life insurance policies to do that. So what happens is let's say, for example, just to use even numbers, I have $100,000 in cash value, and I could borrow up to $90,000, maybe a little bit more, maybe 95%, but for the most part, it's about 90% I could borrow. And I could use those borrowed funds to invest in passive deals, in syndication, or other types of structured deals. And what happens now is I don't interrupt the growth of my policy. So I have, for example, $100,000. I borrow $50,000. I invest $50,000 into a deal with somebody else. Let's say 5 years later, I get that money back plus the profits. While I have that money working for me, I still have the cash value in the policy continuing to grow. In other words, whether I borrow the money or not, my cash value in the policy continues to grow and continues to compound. And then people are like, how is that possible? The way it's possible is that when I have my $100,000 cash value amount and I go to borrow $50,000, for example, I'm borrowing from the insurance company's general funds, and not subtracting from my principal. I'm borrowing against it. The same thing how if you had a house that was worth $500,000 and then you borrowed $100,000 from a different source, you're not subtracting $100,000 from the value of the property, right? You're borrowing against it. The home is still worth $500,000. The home will still appreciate. If it's in a good market, it would still appreciate at its given rate, but you have an outstanding loan against it. And the same is true with life insurance.
Wow.
Okay. So I'm kind of curious, when you say cash value, how does that compare to the actual value? Like if you died, like the value of the life insurance yourself?
See, that's what I said.
I'm killing him off.
Yeah, that's a good question. So as you are funding a policy and paying premiums into it, two things are happening. One is you have cash value, like that's one limit, and then the other is you have life insurance or death benefit. For the most part, the life insurance is about 10 times greater than the cash value. That's not our general rule. That's just kind of an approximate measurement. So if you have $100,000 in cash value, you're probably going to have like $1 million in life insurance. And then this brings us to the point of you never have to pay back the loans. And the reason why you never have to pay back the loans is because the insurance company knows they're going to get their money back eventually. So if you have $100,000 in cash value, you borrow $50,000, you pass away, they'll take $1 million, subtract the outstanding loan and the interest associated with that loan, and then pay that to your beneficiaries. That's really how you could keep using the money in and out without any credit checks, without it being on your credit report, without any other collateral except for the policy itself. That's why they call it infinite banking, because you could keep using the money over and over again as many times as you want.
Wow.
Okay. I should have not had the glass of wine before.
Yeah, it's getting complicated. No, it's nice though. And you can, what happens if you're not in good health?
Yeah, so you have a couple of different options. So typically it does, if you're not in good health, it's not an automatic denial. So there's something called like non-standard or substandard rating. That's where they'll still accept you, but at a higher rate because of that. Or you could even get approved with some companies at standard rating. This is where like we talk to the underwriters, we get to know your like situation, and we kind of like figure out a way to get it approved. But there are ways. Now, let's just say, for example, you're uninsurable, meaning that you cannot be insured. Let's say, for example, you own a company and you have a business partner. You could have your business partner as the insured with you as the owner. Let's say you're married. You could have your wife as the insured, and then you two would be the owners of the policy. Or let's say you have kids that are adult children, or you could have them as the insured and then you as the owner. So there's a lot of things that you could do, and a lot of people do these strategies regardless of insurability. So they're doing these things. They're insuring partners, insuring children, insuring spouses. Even though they're all healthy, they're doing that for specific reasons, like for retirement planning, for college funding, for business legacy continuation. They're doing all these different things, these creative things. So to answer your question, you could insure other people as long as there's insurable interest between you two. So like married spouses, kids, business partners, employees, you could insure your employees. There has to be some sort of reason for insuring each other.
Okay, cool. So yeah, so we always talk about other people's money, OPM. I'm sure you're in the real estate world. So other people's
Life
insurance, OPI. Yeah. And I love the OPE, other people's experience. So other people's insurance. This is getting exciting. It's a new source of funding. So that's great. And like you said, it doesn't appear on your credit. And is it taxable? I guess it does vary per country, but is that money taxable?
So yeah, so just to be clear, I'm not a tax professional, so consult with your accountant, your tax attorney before doing this. But I'll speak in as far as in the U.S. In general, the growth of the policy grows tax deferred. So let's say, for example, I have $100,000 in cash value, and the rate of return is not that big with the whole life policy. That's mostly about what you could do with that money, not just about it growing. But let's just say 3%. So the next year I have $103,000. I don't pay taxes on that $3,000 that's in the policy. And in almost all situations, when you go to borrow that money or withdraw that money, it's coming out tax-free, even if there are gains. The only times, and I'm speaking in U.S. terms, the only times you would have to pay taxes on loans or withdrawals if it's something called a modified endowment contract. That means that the policy is designed, it wasn't properly designed, and it's designed almost like a 401k or IRA is, where it's an investment vehicle now. It's lost its life insurance privilege, and now it's an investment vehicle. Now, I don't know that much about Canadian laws and Canadian taxes, But I will say that, we mentioned infinite banking is present in Canada, and we actually have bank on yourself professionals that are in Canada, all over Canada. So it does work similarly. Talk to a bank on yourself professional, talk to an accountant, a lawyer, but it does work similar to that of the States.
Yeah, I've spoken to a few people, practitioners or whatever you guys call yourselves, and it's very, very similar. So same idea, like 401k. Here we have RRSPs, registered funds. It's very similar. There's some variance, but the money does grow. It's like another tax shelter, and it's a source of funding. But there is kind of a funding component to all this. Like, you don't put in $1 million and then you can pull out the money, or
how does that work? That's what I was I'm sitting here like scratching my head. So when you say cash value, how do you get the $100,000 cash value?
Yeah, perfect question. So one of the things to consider with infinite banking is that there is a period of time of capitalization, meaning that it's not like real estate. You can't use $10,000 to buy $50,000 worth of property.
You don't leverage.
Exactly. It's the opposite of that. Usually you have to put in premiums. You still have cash value like in year one, but there's like a slight dip between premiums and cash value. So for example, you would put in, depending on the health, depending on the person's age, you would put in $10,000 year one, and your cash value might be like $7,000 year one. Now but then what happens is year two, as you're funding the policy every year, eventually after about year 3.5, year 4, give or take, the cash value ends up exceeding what you're paying into it. So like year 4, you would put 10,000 in. Now the policy is growing by 12,000, and then year 5, you put another 10,000. It's growing by like 14,000. So eventually, the cash value outpaces what you're paying into it, and it even outpaces the growth of it. So for every year versus cash value, again, there is a period of time where you have to build up the policy. Now, there are some policies we have that are like single premium cases. What that means is you just put like a one-time payment into a policy, like $100,000 into it. That's it. No more premiums are due. And then your cash value right away is $90,000. You could leverage that, and then you could use that and buy properties, pay it back on your own terms, and do whatever you want. So there's some things like that, but for the most part, it's a long-term strategy, and it's a way for you to kind of cut out banks and lenders for the future moving forward.
Yeah, so it's not instantaneous. Like, sounds really exciting, but it needs some planning. And as you said earlier, it needs to be well designed. So can you tell us like about a bad design? I know you said if it's too much of an investment vehicle, then that's a bad design. Are there other caveats or things to look out for?
Yeah, so I guess there's two things that could happen with a policy. One thing that could happen is if you overfund it to the point where it's an investment vehicle, it becomes a modified endowment contract. And then that's not always a bad thing, but about 90% of the time we avoid that because we want this to be a tax-free vehicle for the future. But sometimes 10% of the time we're intentionally doing a modified endowment contract because it fits the client's needs and wants, and sometimes it does make sense for them. But for the most part, that's one of the downsides is that it could be a modified endowment contract due to overfunding, and it's an investment-like vehicle now. And then the other downside that could happen is that it could be the opposite, where it's like it's entirely life insurance and very tiny cash value growth. We don't want that, obviously. So we want to be kind of in the middle where it's as funded as high as possible, as much cash value as possible, but on the tax-free side. And now the way that it could happen on this side where it's entirely life insurance, it's something called base life insurance. So every policy, every whole life policy is considered base life insurance, where it's just straight life insurance. But where the magic happens is from the paid up additions rider. And this is where you add like a piece on top of the policy that helps it grow. It helps the cash value grow. So if you did a policy that was 100% base, it's just going to be life insurance only. You won't see any returns really. Maybe like 15 years later, you'll see some cash value growth. But that's when it's all base. Whereas if you do like a policy that's half base, 50% base, and then 50% paid up additions rider, now you can start seeing that turbocharged cash value growth. You don't want it to be too much paid up additions and very little base, because if you do that, you could risk it becoming a modified endowment contract in the future. So again, this is where you want to work with an advisor, somebody who knows, paid up additions rider, base, premium, modified endowment contract, knows how to like level everything up. So that way it could be a tax-free contract for the future, while also giving you liquidity and control. Like when you hear a lot of like gurus, like financial gurus, like say like, oh yeah, stay away from whole life insurance, it's a terrible investment. It could be, yeah, they're right. It could be a terrible investment if it's not properly structured from the right companies with the right amounts. And more importantly than everything is the advisor. You want to make sure that the advisor really knows this stuff, and they're not just life insurance salespeople. They're, financial planners that could help you with your specific goals and your specific objectives.
And you're real estate investor focused, so that's great for anybody listening. We do have some listeners from the US. I did see on our podcast, so that's great. I mean, Chicago sounds like a great spot. I've actually never been, but
really?
we'll have to go someday when things are more reopened. But
so you're a young guy, Sarry. Tell us a little bit about you. How did you get into the infinite banking?
Yeah, so it started from after college. After I graduated, I just kind of became addicted to reading books. I would read like 3 books at a time. And, I got my master's degree in business. I was going to go to law school, but then like at the last minute, I just changed my mind. I wanted to be more on the business side. So I got my MBA in Chicago. And while I was doing that, I was working at insurance companies. So it's kind of bouncing around with insurance companies. And I started to really like the way that insurance companies operated, from the way that how they were always looking for new customers, but they were still picky about their customers. They wanted to, they were really good at risk management. And that kind of opened up my eyes. And again, with reading books, I just found this book called The Bank on Yourself Revolution by Pamela Yellen. And the book was like, talking about the problems with conventional financial vehicles out there, like the stock market, bonds, mutual funds, index funds, 401ks, IRAs, things like that, and the problems, and especially after 2008, how were like uncovered. So while I was reading this book, I was like, I already have a client base. I'm already in the insurance industry. I wanted to kind of adapt to this more towards infinite banking and bank on yourself. And I did. And that's when I started the company Financial Asset Protection. So to answer your question, I really found all this just from like reading and kind of like constantly looking for different solutions for clients. Yeah. And I'm happy. This is what I do full time now. So it's mostly full time on the financial planning side for real estate investors.
Oh, that's so interesting. So can you just like for the everyday person, kind of explain the difference between like putting 100K into just real estate investing and just getting a cheap insurance policy, like life insurance, or putting 100K into the infinite banking insurance?
Yeah, that's a good question. So that's typically a valid concern where people have. It's do I get whole life insurance and pay the additional premium and do everything else, or do I just do term for a fraction
10 years, 20 years,
20-year term, exactly, and then invest the difference other places. And I think the answer to that is you'd want to evaluate. So I guess you first thing you want to do is evaluate your objective first. What is it that you want to accomplish? What is it that you want to accomplish 10 years from now, 20 years from now, 30 years from now? Assuming that you want to be, to get further into real estate, I would look at both. I would look at if you funded the whole life policy versus did the term and just conventional funding through real estate, like how everybody else does it, There's pros and cons to both. So the benefit on the whole life side is that you will always be able to access the money. You'll always be able to pay it back on your own terms. You'll always be able to borrow over and over again as long as you have cash value. The disadvantage on the term side and the whole life side is that, the term and then borrowing and other types of financing is that you're always going to have to abide by banks' rules and banks' financing. And who knows, banks are typically in control of that. A lot of people are also they think about financing as in like my credit is good, my income is good, I have the collateral, I can always get financing. And that's not always true because banks have their own rules. They have board of directors, have their own procedures for, so for example, like Wells Fargo or Chase Bank could say, hey, you know what, we're going to stop financing, real estate investors in this area, and they could do so. It's their money, it's their rules. Yeah. So you never want to be tied down to their terms and conditions. You want to always be in control. Now, there's many, pros and cons on both sides, but that's just something I kind of think of like quickly, like right now, to answer that difference. So you're in control of the financing. And another thing too is that banks do is they measure like market performance, they measure other like unemployment rates and other factors around the country and the economy to determine the likelihood that their borrowers will pay back. So a lot of people, who have good credit, who have good income, who have these good things, don't always have those things because, life changes, the economy changes, industries change. So people like lose their jobs, they might lose their business, they lose employees, things like that happen. So banks are kind of ahead of the curve in that. So when markets start going downwards, unemployment starts going up, that's another reason why banks start holding back on financing. Whereas insurance companies don't do that. As long as you have the cash value, you'll always be able to access the money. Let's say there's another 2008 happens. The people who can come out ahead are people who don't rely on banks, like who have access to money and whole life insurance policies. there's no qualification like everybody else has to qualify for those funds.
So it's a good hedge against the like COVID, for example. I mean, it won't protect you against COVID, but the effects on the economy, and like 2008, like you said, and remember we're much older, the Y2K and the dot-com bubble and different things. I mean, the economy goes up and down, and in Canada as well, as you mentioned, the banks have rules, but then there's also the federal bank that that can, I don't know, they just increased the stress test in Canada. The interest rate on mortgages are, from what I'm seeing, they're much lower than in the States, but the stress test now is almost at your level, like 5-6%. So you have to qualify, even though you have great credit, and you don't really need to qualify that rate. You could get 2% or even 0.98, like we saw the other day. So, but that stress test they keep increasing it. And, or like in New Zealand, investors need to put in 40% down instead of 20. In Canada or in the States, you can do a bit lower. But so these rules, if you have that, then you have the cash and you do your own deal. So this is really exciting. So what do you recommend if someone wanted to get started? You go all out and put in 100,000 a year, or what's like a logical first step?
Yeah, logical first step is become familiar with the concept. We only want to work with clients who really kind of are prepared to do this long-term strategy. So get familiar with it. There's a book called Becoming Your Own Banker by Nelson Nash. I could actually send you a free copy of that book. If you guys like, I can send it out to the listeners who reach out. It's Becoming Your Own Banker by Nelson Nash. Another book is The Bank on Yourself Revolution by Pamela Yellen. You could also look up on podcasts and YouTube, Infinite Banking, Bank on Yourself. So kind of get familiar with the concept, how it works, the pros and cons to it. And then after that, make sure you're working with an advisor, somebody who specializes in not just somebody who has a life insurance license. A lot of people have life insurance licenses and could sell life insurance, but you want to work with somebody who has a track record of working with, people in your niche. Like if you're a manufacturer, you want to work with somebody who specializes there. If you're real estate, work with a, real estate infinite banking professional, somebody who specializes in real estate. So it's more about the person than it is about the product, And then after that, once it comes into funding, we always do like a financial analysis with clients. We want to understand their financial situation and then understand where they want to go, and then use the policy to help them connect or bridge to their goals. One common thing that we've seen is, when you start off with a policy, we would, for the most part, again, not a general hard rule, but for the most part, allocate like 5 to 10% of their annual income, pre-tax income, to whole life policy. So if they're making $100,000 a year, we'd allocate like $5,000 to $10,000 a year into their policy. Again, it could be more than that. It could be way less than that. But that's kind of where we start off with. Some people end up becoming like experts in infinite banking, the customers, and they end up doing like 100% of their income. All of their money goes into infinite banking, and then they just borrow on the other side when they need to pay their bills. So it's like a martial art. You can start off with a white belt, just doing very basic, and then all the way to a black belt where you have your own lending company and you're borrowing from yourself, and you're getting tax deductions and all these like masterpieces.
Yeah, because that's what Mr. Nash, I read the book, and that's what he said. Let's say you're buying a new car, then get a new policy for, I don't know, $50,000, and then pay your car out of your own money, your own bank. You need a house, get policies in place for the house, a trip, so for investors, let's say you get your rent roll, which could be substantial money. I don't know, $40,000, $50,000 a year, then get a policy, flow that money in, and then you build more of that banking. So this is really interesting. It's still kind of foreign. I still need to do some more reading.
I'm gonna have to read that book myself. I'm telling you, I keep trying to. It seems like just such a weird, almost like abstract concept to kind of wrap your head around, even as a real estate investor. So what's your biggest hurdle, I guess, kind of getting real estate investors on board for this?
Yeah, it's definitely a mindset shift, right? If somebody's only used to just putting 20% down, bank financing, and then they just keep, reinvesting every dollar they have back into down payments, into renovations, and they just keep, people are experts in this space, right? So that's what they're used to. They may have even learned from their parents or, from mentors. So when I come in and start talking about infinite banking and how they could replace banks, it's a foreign subject, like you said, and the pushback is what they believe in. That's actually most people carry out their actions, execute actions based off of what they believe in, you know?
Yeah.
So that's the biggest pushback. Even though it's logical, it makes sense. If they weren't raised that way or believe in it that way, it's going to be very difficult, you know, for them to understand it, which is where the content comes in, right? Like the podcast, the YouTube, the audio, the books, everything comes in. It's a process that you would have to kind of be coached through and understand. And definitely helps start with like smaller policies first, and then get the hang of it. And then once you could see it, and learn from it, then it helps to scale with it, like to get more policies. It's just like real estate, how you would start off with one home, leverage that for the second, leverage those two for the third. The same is true with whole life insurance. Like my mentor has 14 life insurance policies, you know, he uses them for each other. Yeah. So they end up like snowballing and then being used for each other. So there's a lot of things we could do.
Oh, wow. That's so interesting. Mm-hmm. So can you get more than one policy on a person?
Yeah, absolutely. You could, for the most part, if you're between the age of like 30 and 50 years old, for the most part, I think, you know, Canada might, so a lot of the companies we use are also in Canada. So they could have similar underwriting guidelines, but it's about 25 times your annual income. So if you make $100,000 a year, you can get like $2.5 million in total life insurance from all companies. So if you did one policy that was, you know, 300,000, you could do another one that's 400,000. You can keep doing as many policies up until you get to like the 25 times mark. And then after that, you can even do more based off of your net worth. So if you have assets and, you know, real estate assets, you can, and that equal like $3 million, you could do up to 3 million. So again, this is all where the advisor comes in. They know how to crunch the numbers. They know how to convey the numbers to the insurance company and how to like negotiate for you to get more life insurance. There's no limit to the amount of policies you can get. There's typically just a limit to the life insurance amount, the aggregate total life insurance amount.
Okay, that's interesting.
The way I see it is kind of, we do, I don't know if it's the same in the States, but we do joint ventures. Mm-hmm. And sometimes we also do kind of beneficial ownership. So we'll buy a property, and then we sign what's called a bare trust agreement. So our corporation is hiring us to buy a property, and then all the income has to flow through our corporate account. Mm-hmm. So it's the same idea here. All the income or whatever you choose flows through the policy. Yep. And then it converts it into available cash, I guess, and life insurance, which has benefits as well if someone dies. But that's kind of how I see it. I think that's like the simple.
Yeah, I can't believe it. Fossil's not a numbers guy, and I think he's grasping the concept quicker than me.
Yeah, exactly. From a you know, conceptually, yeah, that's exactly how it would work. You could put the money through it and take it out. A lot of, you know, general partners use it to protect themselves in case something were to happen to them. Because like imagine if they collected like $2 million and then they passed away, you know, you know, to pay the investors and everybody, you know, it's just kind of a little tricky. But if you had a life insurance policy, and a lot of, you know, general partners do this, where they'll collect the funds and go into a life insurance policy, obviously disclosing everything to the investors. Then if something were to happen to the general partner, then it would go to the investors, you know, so it would subtract from their liabilities.
Okay, that's so interesting. I'm gonna really have to read that book.
Yeah. I can read the book.
Have you read The And Asset as well? That's another kind of spin-off of things here.
Oh, The End Asset?
Yes.
No, I haven't.
The ampersand symbol. So it's The And Asset, which is basically, it's kind of a summary of the infinite banking concept, and it's been adapted to the Canadian market. So there's an American version, and recently they launched a Canadian version, and it's great. It's simplified and a bit more modern. Mr. Nash's book is great, but I don't know when it was written. Some examples are very dated, but it still applies to today's information. It's just, he was talking more about single income families, which is quite rare now, and well, I guess single moms and things.
So is this a new concept, infinite banking, or has it been around for a really long time?
So the use of cash value whole life insurance has been around probably as long as the United States has been around, you know, so it's been around for hundreds of years. Wow. But the infinite banking terms and bank on yourself, I think probably like 20, 30 years old. So fairly new, fairly modern. I guess more of the marketing behind it. But if you look back at the Great Depression, the people and companies who made it really through the Great Depression were people who had whole life insurance policies because they had cash value, and the insurance companies weren't affected by the Great Depression.
That's true.
Oh, that's so interesting.
That's great. Wow. So what's next for you? So you've been doing this for how long?
So total overall insurance and financial services, like 6 years.
Okay.
One goal I have is probably in the next 5 years, I want to start like a national not-for-profit organization where I just help people with free financial advice. Like I have like volunteers who help people with free financial advice, people who are going through bankruptcy, foreclosure, who can't afford their bills, who need financial support from financial coaching, completely for free. Like maybe even an app where they can just like download the app and talk to somebody completely for free. Our only funding will be from donations. I don't know how to do a not-for-profit organization, so it's probably gonna take me some time to learn. But yeah, that's something I have, like maybe a 5-10 year goal that I have.
That's really cool because there's so much need out there, and it's so sad. A lot of people don't know all the resources are there, and you don't yes, you need money for things, but you don't need that much to get out of debt and to grow wealth. You can start small and really change your life. So that's such a good goal and objective.
It's a noble cause because it's unfortunately not really taught that much in school, anything about finances. So if your parents didn't teach you, then you're kind of at a loss.
Yeah, and it's generational oftentimes. If your parents don't know, then you do the same and it just keeps going. We see that a lot, unfortunately.
Yeah, absolutely. I always talk about this actually a lot in podcasts. We're not taught, this in school. I think we start to learn about money when we start working and start paying our bills. That's when we truly, and for some people, that's like the age of like 24, 25 years old. They learn about that like later on, way later on, where they have to actually pay their own bills and stuff like that. So if we can kind of get a head start and nothing too serious, just like basic accounting, basic economics, basic finance, like as early as like junior high school or high school, that'll, I think, make a big difference for the overall country, right? Oh, sorry.
Yeah, absolutely. Oh, it says you're looking for your phone.
Yeah, the cat was looking for the phone. That's funny. Cool. Well, thank you so much. It's been a pleasure chatting with you. And how can our listeners get a hold of you if they want to find out more or get a free book, like you said? Or
so if they reach out as a thank you for making it all the way to the end of the show, I can send them a free copy of the book, The Becoming Your Own Banker. If they go to finassetprotection.com, it's FIN assetprotection.com. There they could schedule an appointment. They can connect with me on LinkedIn. They can connect on YouTube. And there's different ways to reach out to me. They can email me. As long as they go to the finassetprotection.com, reach out to me. I'll send them a free copy of the book, Becoming Your Own Banker by Nelson Nash.
Oh, that's so cool. That's awesome. Well, thank you so much for being on our show. It's great to hear a little bit about financing and real estate all connected together.
Yes.
Thank you.
Hearing about a success story. So thank you. And let's stay in touch. And I can't wait to hear about your future successes.
Yep. Likewise. Thank you so much.
Cheers.
Thanks.